We were very pleased with the group's results for 2014. We've had a very good year operationally and financially, with especially good results coming in from the emerging markets, and overall we were very much in line with the board's expectations. In terms of some of the operational highlights, we've set out in our Quickening the Pace strategy 3 key performance indicators, and I'm very pleased that we achieved all 3 during the year. Firstly, in terms of our earnings per share, that came in at 5%. In terms of our visitors, which is one of our key metrics, we were 6% against an industry average of 1.8%. And in terms of our geographical spread, in terms of the business in emerging markets in the US, we had a target of 75% and we achieved 80%. In addition, we replicated 2 of our major brands into Indonesia, in the automotive market and also in the houseware market. That was in addition to 5 key strategic acquisitions, 2 in the emerging markets, 2 in our medical business in the US, and 1 into the new disruptive 3D technologies, which we are expanding rapidly in the current year.
2014 was a good year for us financially, underpinned by like-for-like revenue growth at 10%. We were battling currency headwinds for much of the year, and that had a 7% adverse impact on our revenues. The profitability was very strong, and that's allowed us to increase our dividend by 7% to 7.8 pence per share. So overall, a very good set of results. Our profits have converted really well into cash, with operational cash conversion of over 100%. Now, we finished the year with net debt of £38 million. That does reflect a very busy year on the acquisition front, but it gives us gearing of 1.7 times net debt to EBITDA, which still leaves us with plenty of firepower to continue our strategy of quickening the pace.
It's early stages in terms of the current year 2015, but January and February have got off to a very good start. Our forward bookings, which is one of our key barometers for the business, are up over 10%, driven not only by our 2 largest exhibitions, Label Expo in Brussels and the Dubai Air Show, but it's actually quite broadly spread. And I'm particularly pleased by the performance of our Turkish business, where our 2 big biennial events in the construction industry, one for construction equipment and the other for lifts, are both performing very strongly. So very pleased with the start to the year. It's going to be a very busy year because we're accelerating the number of replications from 2 last year to 13 this year. So it's going to be a very busy year, but we're progressively more positive as we go forward in 2015. In terms of the longer term outlook for Tarsus, 2 years ago we outlined the Quickening the Pace strategy. We're now pleased that we've got into the geographical markets that we wanted, and that's 6 key markets for us: China, Southeast Asia, Turkey, Dubai, Mexico, and the biggest market in the world, the US. So we continue to look to grow in those geographies. We're looking to be a good partner and a good home for entrepreneurs who want to stay with the business but want to build it and develop their brands into being true international brands. So going forward, it's going to be more of the same, more replications, focus on organic growth, replicating our international brands, and where we can find good strategic add-on acquisitions, we'll do those as well if we can accelerate the growth of what we've got.